Welcome to TheoTrade. This is Don Kaufman. May 21st, 2021, minutes after the cash close here on this Friday afternoon. Will the crypto crush spill over to the stock market? We're going to answer that and a lot more here on this weekend update. Let's get to work first and foremost talking about the general marketplace. In fact, to do that, we're going to bring up the SPX, the mother of all products. One of the first things that I would like to point out, well, we are massively unchanged in the entire week. In fact, this is the exact same range that we have been in now. Well, count it. You got 1, you got 2, you got 3, you got 4, it's 5, it's 6 weeks in a row. 6 weeks in a row, we're talking about, well, relatively, again, the exact same range. And that range, and again, I want to be even a little bit like, liberal in drawing this, but that range is roughly from 4,200 to 4,100. You're looking at like, 100 S&P point range. And yes, I get it. We cracked outside that range for just a brief and fleeting moment, maybe the week before and last week. But this, week, we actually cracked to the downside, a little bit of a crack to the downside. But nevertheless, there is some fairly high volatility in an incredibly tight range. But as we're going to talk about here in just a few minutes, some things have absolutely unequivocally changed in the last 2 weeks of trade. When I talk about like high volatility in a tight range, like how do I quantify that? And I think that's kind of, it's up for debate. It's up for discussion. One of the things I want you to see is the expected move here inside of the SPX. And again, these lines, of course, delineate my hand-drawn expected moves. And I actually do. I sit here and I actually draw expected moves. I haven't even drawn the expected move for next week. And the reason I haven't is because we just closed. We just closed a few moments ago, and some of the expected moves are not necessarily settled out. What I wanted you to see is in this past week of trade, we're looking at like a high volatility tight range. Again, how do I kind of quantify this high volatility? Well, you had just shy of an 80-point range that we were supposed to be within. And that was, to be really specific, it was a 78-point range, 78-point higher, 78-point lower. What did we actually do? Well, we traded considerably lower. We actually traded all the way down for, again, a brief moment, all the way to the 40-60 handle. For the most part, you're looking at about a 120-point down move followed by a 120-point rally in there. So keep your helmet on, people, because that, again, it was some pretty serious volatility. Once again, Wednesday happens to be volatility day, right? The previous week, we saw some heavy volatility. The week before that, well, we had absolutely nothing the week before that, but the last two weeks have actually thrown off considerable volatility. The interesting aspect about this, and again, to kind of delineate this a little better, I'm going to cruise over to the spiders. You can see, obviously something's changed in a big way in the last 2 weeks, because we're not just throwing off big ranges. I mean, it's just a gap-filled wonderland. And the reason I switched over to the spiders is the spiders are not like, if you look at the S&P futures, the S&P futures are a much more continuous contract because they're open like 24/7. But the spiders, they actually show you like, whoops, swing and a miss. We dropped huge. We rallied. Again, it's disconnected. It's broken trade right now. We're all over the place, but yet we're still in an incredibly tight range. And I can't stress that enough. Again, high, impact trade in a very, very tight range, but the volumes, okay, they're picked up briefly, but they're not exactly rocking towards the end of this week. And that's the volumes here in the spiders. That's the volumes in like the S&P futures. It's just pretty humdrum, in today's session. But then again, today here on this Friday, we closed massively unchanged. On the flip side of that though, okay, so, we're looking at this tight range. One of the things that just doesn't really kind of jive with that tight range is look at the VVIX, the volatility index. And what this is indicative of, it's hedging, right? If you're in need of a hedge, what do? You can actually run to the VIX, and you can actually run to the VIX options. You can buy up a bunch of VIX calls, right? You can buy VIX calls 60 days out. You can buy VIX calls 25 days out. You can buy VIX calls, any place you want. And in buying VIX calls, okay, you'll actually drive the VVIX higher. So I want to clarify something in this respect, because when you're looking at the VVIX, it's the volatility, again, of the volatility index. The only thing that really drives the VVIX higher is all right, the purchase, if you will, of the calls. Like, again, just to clarify what the VVIX is, it's the VIX of the VIX. So it's like an intensity level of the volatility, if you will, of the volatility index. It's again, but it's insightful to see that. Look at the professional world hedging. Okay. Now, are they hedging saying that a down move is coming? No, not necessarily. Okay. Are they hedging because they could be a little scared? Yes. But I also want you to think about this. They may not be hedging at all. They could actually just be taking outright bearish positions in the S&Ps, because if the S&Ps tank, then of course the VIX explodes, higher. But neither here nor there. The bottom line, okay, with this, and this is the one like kind of context I want you to take away from this, okay? This is very likely hedging activity, which means that professionals have their risk mitigation tactics in place, which means they don't have extraordinary risk to the downside. That unto itself is not bearish by nature. It's actually a little bit more bullish. With the VVIX, okay, comes SKEW. Now, the best way to look at SKEW, if you ever look at SKEW and it's like dots on a screen, SKEW yesterday, and SKEW actually doesn't settle out for like another hour. Yes, it only literally prints like once a day, but SKEW is actually at 143 yesterday. And again, it's like scatter plot. They only calculate it once a day. Come over here if you're on thinkorswim, go to style, go to candle charts and change it to you can use line or area. Whatever does it for you. Like here's an area chart, which is actually kind of cool way to kind of display this. Sometimes a little bit better than a line. It's pretty. Anyway, look how high SKEW printed. In fact, it's worth going back. You can even go back like 10 years. Okay, it's basically some of the highest prints we've ever seen. Okay, SKEW prints near an all-time high. What is the all-time high? I mean, the 150 level, and again, brief and fleeting moment, even above that. But what this entails, again, what is SKEW? What am I looking at here? It's actually measuring. To be specific, it's the SPX, but it's easier to look at in the spiders. Okay, it measures, if you will, way out of the money implied volatility of puts versus way out of the money implied volatility of the calls. The higher the SKEW number, okay, the more the difference from the out of the money puts to the out of the money calls. So, the way to really display this to you is if you look way out of the money. I mean, way out of the money. We're talking like 346, 345. The implied volatility for that option is sitting at like 35%, which is really, really high. So how does SKEW get high? Often it's traders buying puts, and they buy puts. And when they buy puts, it costs them a lot. So what do? They turn around, they buy puts, and then they finance the cost of those puts by selling calls. And it literally skews the marketplace. So here again, in the VVIX, we have evidence of hedging. In the SKEW, we actually have evidence of hedging. Seems to me that the marketplace, anybody that's anybody, got you hedge on. Question is, where's the retail client left? Okay. And again, I'm not trying to really portray this as being bullish nor bearish. Okay. But it's important because we haven't seen markets that sell off. Like, I'll just give you an example of this. The market sold off hard at one point, really hard at one point, on Wednesday, and the previous Wednesday also sold off. But what's interesting about this, and that we have not really seen historically, the SKEW never dropped. Usually when the marketplace sells off and sells off hard, SKEW drops, okay? Because what occurs is as the marketplace is dropping, all right, professionals are often selling puts, and the sale of puts, okay, into the volatility. What that in effect does is actually flattens out SKEW, and SKEW has not flattened, okay? And none of us can explain why. And anybody that tries to is, again, the entire industry is looking at this like, I don't know, okay? You know that people are hedged right now, but you also know that there's some glimpses, some serious volatility, and SKEW hasn't flattened. So there is a perplexing nature to what's going on kind of in this market update here, not to mention, again, the type of volatility that you're seeing when, this can't be like overstated. You had a 120-point move this week. And again, I just want to zoom heavily into it. You had a 120-point move down this week, followed by a 120-point move up this week. Okay, that's big. SKEW doesn't change. The VVIX is absolutely rocking, but take a look around because there is one big change, and that's this sector expected move. So we're looking at an expected move right now in the SPX, but let's actually cruise over to the QQQ. If you take a look at the Qs, we'll actually apply auto expected moves. The QQQ, it's interesting because the Qs were actually outperforming in the week. They pulled back. So what did the Qs end up doing? Absolutely nothing in the week. It's interesting, right? Qs did nothing in the week. What did we look at? We looked at the IWM. What did the IWM do? Absolutely nothing in the week. Even though the Qs sold off a little bit today and the IWM finished rather flat, absolutely nothing in the week. Absolutely nothing. You'll learn real quick by looking at the spiders, the Qs, and the IWM. All of a sudden, we correlated. There is a high correlation coefficient in the midst of some volatility, which I'm going to talk about here momentarily. Let's look also at some sector ETFs, though. In terms of sector ETFs, look at the financials. The financials, ooh, they actually sold off a little bit. I mean, when I say a little bit, I do mean a little bit. They barely moved, okay, as well after having a big sell-off and rallying back over here. Look at the energy sector. What's the energy sector? That's actually one of your worst performers in terms of the week. Okay, so I'm just looking at the Nasdaq and I'm looking at the XLF and looking at the XLE. Hey, listen, those are things that are moving markets right now. And of course, somebody inevitably, they're like, please, why don't you pull up stuff like XLP? Because no one cares. No, if you look at like XLP, if you're not familiar with it, it's consumer staples. It looks just like the S&Ps. All right, we could pull up, again and again and again, ETF to ETF, but I'm pulling up the ones that are really driving the market. And it's right now, okay, in a big way, it's Nasdaq. Like it's Nasdaq versus financials, a battle to the death of good and evil, except both of them are kind of evil. Anyway, the sector expected moves, they display there's a high degree of correlation in here. So let's talk about the major markets moving forward, and then we're actually going to jump back. We're going to talk a little bit about the crypto smackdown that is spilling over to the marketplace. So markets moving forward, first of all, let's actually talk about the financials, which is one of the reasons I have them on the screen. The financials, they're still hanging tough. I can't, explore this any deeper than I have in the last couple of weeks. The financials, if there's a place like, listen, if you think the marketplace is going to tank and there's a place to short, it's the financials without unequivocation. The financials, when I say they're hanging tough, okay, zoom out for a second. There's not even a glimpse of them really selling off. You compare that, for instance, to the monsters of tech. The monsters of tech is like your conglomerates, your Apple, it's your Amazon, your Facebook, your Google, Microsoft. Yeah, it's sold off a little bit. Start looking at individual stocks, okay? What else you got? Look at the energy sector. The energy sector, it's a little bit damaged. Just got a little bit of damage over here. Then you start looking around at stuff like some of the home builders. Okay, if you hadn't looked at XHB, that's starting to get a little bit of the smackdown, right? Everywhere you look, there is a degree of some sell-side activity, except inside of the financials. Now, this does not mean that the marketplace is going to sell off and sell off huge. It simply means if you want to get bearish on the marketplace, okay, sure, you could go out, you could just sell the spiders, okay? Sure, you could do that, but your risk reward might be the best inside of some of the financials. And to get really specific, like what do the financials look like in a year-to-date basis? That's when you go into the financials. Take a look at Wells Fargo. Come on, things up 55% year-to-date. Morgan Stanley, only 30%. Bank of America, 41% year-to-date. Like it couldn't be easier than to just flip through here and you're like, wow. Okay, Wells Fargo, that's the object of my affection right now, and I carry a couple of short positions in there because, again, I'm a bear. Okay, nothing like being a bear. So financials are still hanging tough, and that's still is the area, the object of my affection right now if I'm going to take bearish positions. Next, correlation. So let's talk a little bit about the correlation coefficient. The correlation coefficient is up. Today, the marketplace ended at almost a 50-50, but I'll tell you what, it didn't start that way. Today, we actually started full-blown correlation to the upside. You know what we had, okay, earlier in the week when we saw volatility? Full-blown correlation. You know what we have in terms of expected move? And that's why I showed you expected move, okay? Didn't think about that. The expected moves, they're all correlating. All of a sudden, the markets the last, few weeks, it was like, and I do want to show you the last few weeks. Look, the QQQ is moving down, okay? Financials were moving up. This week, everything started moving like in relative tandem, like literally they started tracking one another. Okay, there has been a stark contrast, if you will, some of the previous weeks of trade, because again, you're starting to see there's no more of this like weird rotation. The weird rotation was literally like, let's get out of tech into financials. Ironically, Yes, this is how the day ended up. Okay, this is how the day ended up. But throughout the course of this week, we've actually seen high degrees of correlation. Of course, as I show you this, you're like, what? They're moving out of tech into financials. That's not the way the week actually went. Everything kind of leveled out towards the end of the week. Nevertheless, look for correlation. Okay, look for the correlation. And when I say look for correlation, like in the morning, and you turn on your screen, look at the S&P 100. Are there 100 stocks up? Are there 90 stocks up? Are there 90 stocks down? Okay, because it matters, and I'm going to show you why here momentarily. Okay, that correlation, it should in fact drive us outside of this range. So what I'm actually, implying in this case is the tight range that we've been in should be no more, and we should actually see it coming. Okay, literally in the next week to 10 days, and that's what. Whenever I'm trying to like handicap markets, listen, volatility is clearly picking up. We're in a relatively tight range. Okay, the correlation coefficient is high. I'm not going to try to handicap this more than a few days out. Forget about, listen, there's going to be catalysts. There's going to be news announcements that are going to drive markets. There's no question about that. But I'm not basing it on anything other than like the implied volatility, components that we're looking at, stuff like VVIX and SKEW. And again, there are some really funky things on the screen right now. So with that, there's another one that also plays into my thinking quite a bit, and it's actually right here inside of like, you can look in TLT, you can look at like implied volatility range. This is actually what we call volatility ranking. And it's interesting to see that volatility is actually up inside of the bonds. Why is that interesting? If you haven't looked at the bonds lately, let me actually clarify this. If you haven't looked at bonds lately, they've done absolutely nothing. Okay, so you tell me. All right, you got a marketplace that's starting to see correlation. You got SKEW really, really high. The VVIX is really, really high. We just go through and check the boxes, right? And all of a sudden, why is bond volatility high? Bond volatility shouldn't be high. The thing hasn't moved, okay? So we are pricing in some pretty considerable risk. We're in a tight range inside of the S&Ps. We're in a really tight range in bonds, and this bond range has, been since what? You got to go all the way back here until like, late February to actually see where this bond range kind of originated from. So you're looking at like, 3+ months, 4 months almost of like this incredibly tight range, except, okay, the big differentiator, volatility is picking up in here. So bond volatility being up has, that furthers this, that, okay, we're ready to start to crack the range inside of the S&Ps. All right, we're going to completely switch gears right now. And we're going to bring into scope a little bit about crypto. So listen, there's not too often that we here at TheoTrade are discussing, too many of the crypto marketplaces. However, for those of you that have been around for a while, understand that, yeah, we do know this market, know it fairly well. So one of the things I would like to do is I'm only really going to display, instead of going, to some crazy, off exchange, I'm actually going to look at like Bitcoin futures. Okay. The other futures contracts we can look at, of course, are Ether futures, which that is just, it's just hideous. It's just, don't look at me, I'm hideous. Okay. Ether futures just got hammered. I'm not going to sit here and explain to you, MACDs and Fibonacci's and Bollinger Bands, because you don't need it. You don't need any of that. Okay. What I want to explain over here is again, this is not, it's not about, should I get long, should I get short, again, the Bitcoin futures themselves are actually down here about 11%. And that's specific to today, right? So, and then again, that's just some of the Bitcoin futures. Push that aside for a second. It's just a hideous outright crash in here. I mean, for the most part, inside of the last 2 weeks, this is, again, it applies to the futures contracts, and futures actually have a premium, okay, over, for instance, the standardized Bitcoin. But those futures contracts in the last 2 weeks literally have traded from 60,000 down to 35,000. In fact, at one point, it was 60,000 down to 30,000. They got a 50% haircut, bounced a little bit, and started to see some more sell side activity. The question for me is not, okay, it's not about like Bitcoin and wanting to get long over here. And I'm going to tell you right now, for what it's worth, okay, for my money, no, I'm not buying it here. Okay, not buying it here because we are in fact starting to see the crypto market is starting to spill over a little bit into the equity market. I'm going to explain it. It's somewhat contained in here. And again, we were going to look a little bit at Ether and Bitcoin, but I decided against that. I don't even want to like look at the charts and so forth, because again, it's neither here nor there. This has to do more with what can occur is the crypto crash, and I say it's only somewhat contained. The crypto crash, though, is actually starting to feed itself. The way that that crypto trades is extraordinarily, if you will, dislocated. It's everywhere. It's nowhere. Okay. It's cyberspace. The point I want to make with that is there's so many different exchanges. Okay. And so many different players involved in that. Okay. There's also an incredible amount of leverage on many of these new exchanges. And, what I kind of call, almost like these pop tent brokers that are now allowing you to trade crypto all over the world. That leverage is obviously feeding a little bit of the crash. There's no question. People are getting blown out of their positions left and right. Whenever there's a crash in the U.S. stock market, you constantly hear, people are just literally besides themselves and getting crushed in here. What I find interesting is, yeah, I've heard of a couple stories already this week of people getting destroyed in Bitcoin, but stories are vastly different, which also kind of delineates that some of those stories, okay, they haven't played out yet, meaning that some people are sitting and nursing some massive gains inside of crypto, and they're giving a lot of it back and starting to get nervous at this particular point, which means we could be at just the forefront of it. But the concern for me, and again, I'm a much more like derivative-based traders. Like if it doesn't have options, I usually don't want to trade it. I like the options market. I like to get a feel for some of the volatility, and that's a tangible market. The crypto market, it just doesn't have the liquidity, okay, to really warrant that. Meaning the liquidity specifically to any option markets that are in crypto, it's not there, right? So it's just not going to give me the feedback that I want as a trader. But what we actually have noticed is that yes, the crypto market is actually starting to play out a little bit into, of course, the U.S. marketplace. And this is, yeah, you can already see right there, the regulators, they're coming right now. The way I want to describe it to you, though, is pretty simple. First and foremost, if you take a look at something like Tesla seeing some sell side activity. Obviously, the reason I'm bringing up Tesla is they have some investments inside of crypto. Elon Musk has, of course, been mentioned time and again, as being, a big, obviously, proponent of crypto. I think a lot of people are probably going to blame some of the comments from Musk, literally last week and this week, for the crashing crypto. He was just poking the needle into the bubble over there. But yes, we are absolutely starting to see some spillover, and I'll show you exactly how this happens. Okay, so how does crypto specifically spill over into the equity markets? And I think one of the first ways to display is like Tesla. So Tesla starts to see some sell side activity because they are and have, it's a very mild investment inside of crypto. It's almost laughable how little capital they have in here. But if you start looking at Tesla on a year-to-date basis, you do realize they're down 20%. Okay, that's a little bit alarming, and some of the more dramatic moves inside of Tesla have actually coincided some of the more dramatic moves inside of the crypto marketplace. The interesting thing about that, though, and again, you can actually draw correlations between the two. The interesting thing, though, some of the bigger crypto moves were actually happening pre-market. Tesla, of course, is a gap-filled wonderland in there. Anyway, so Tesla starts to see a little bit of sell-side activity. The other one that really kind of played into it was Coin. So Coin actually just came out, and I'm just going to sum it up in this. You get some sell side activity in Coinbase because obviously, okay, this is the place that everybody's going to actually trade crypto. Crypto gets crushed, okay. It's not going to end well for Coin either, simply because the number of transactions are going to be down, and obviously there's going to be some sell side activity. So you sell a little Tesla, sell a little Coin. Before you know it, you're starting to actually sell ARK. Why are you actually selling ARK? Because as Tesla and as Coin are actually descending, it is actually causing some sell side activity specifically to ARK. And people, they miss this. And if you're unfamiliar with ARK is actually Cathie Woods. Not here to pick on Cathie Woods in any way, shape, or form. The point, though, being is there are going to be redemptions inside of ARK because there's sell side activity in Tesla, sell side activity in Coin, which is actually hurting the performance of ARK. The more you hurt the performance of ARK, the more people will actually sell ARK. And if you start to sell ARK, which is again an ETF, guess what? They have to actually sell some of the components of ARK. What are some of the components of ARK? First of all, ARK is down about 15% a year-to-date basis. So when I say there's going to be spillover, it's easy to point to Tesla. It's easy to point to Coin. There's dozens of different products, though. I just wanted to point to Tesla and wanted to point to Coin because they've got larger market caps, right? But ARK, okay, ARK over there has, close to what I think it was 23 billion under management. So if you start to sell ARK. Let's go to that. You get that Tesla and coin can actually drive ARK down, but if you start to sell ARK, then what else do you sell? Okay. Start to sell things like Baidu. Why Baidu? Baidu's part of ARK. It's owned by ARK. It's, so Baidu actually gets whacked down. I'm sure people come up with other reasons to sell Baidu. Okay. You start to sell things like Zoom. Zoom is actually down on a 12% basis. Okay. On a year to date, you start to sell things like TDOC. Okay. By the way, every single underlying that I'm bringing up are actually the primary constituents of none other than ARK. Teladoc's actually down on the 30%. Okay. The number 2 stock actually owned by ARK is actually Square. It's down about 10%. They're all relative to one another. Okay. And the one thing that people, they think that, crypto trades in this like autonomous bubble in its own little world over here. No, it's absolutely unequivocally now spilling over into the US equity marketplace. And you need to start to look at that and take it a bit more seriously in the very near term. And the reason you need to take it more seriously, we're not actually sure at this point in time, okay? As I said, well, it's crypto is, crash is only somewhat contained. It's not going to be completely contained because we know that there's been crossover from people trading crypto and simply trading into the equity marketplace. You get crushed in crypto, you have to blow out of positions inside of the equity markets. All I actually started with is the fact that you actually sell Tesla and you sell coin, you're actually selling into ARK. You sell ARK, it's actually causing other people to have redemptions, and literally it's trip like a domino effect. Okay, you start to sell ARK in a bigger way over there and you start to take down Tesla, that's going to take down the S&Ps, right? Because Tesla is one of the primary constituents of the S&Ps. It actually starts to knock down the Nasdaq and you are off and rolling, people. Last thing in this weekend's update is SPX Expected Move. It's almost identical to the previous week. So if we do bring up the SPX, again, the mother of all products, we were sitting this past week on about, as I said, a $78 expected move. This coming week, about a $76 expected move. So sit tight. I, once again, believe we are going to see some decent amounts of volatility. The one really amazing thing of the last 2 weeks of trade, I got to say this, okay? I can't believe that we ended up inside the expected move. All of that to get absolutely nowhere. You're looking down the face of some more volatility in this next week of trades. It's unquestionable. Look for the correlation coefficients to kick in. Look for that crypto crash. I mean, listen, crypto can trade over the weekend, and things can get absolutely wild coming into Monday. Again, I think it's unequivocal that it is spilling over. We're actually going to go into a lot more depth of this in the next week. The markets are going to find out for the first time, is crypto going to be contained or is it going to actually spread? It's when we start talking about what we call systematic risk and systemic risk. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.